Preface. Early traders dealt with competition on a relatively smaller scale as we do today. Most businesses were run mainly on the business acumen and knowledge of the trader without much study about the theories that rule the world of business. While economics has excited as a branch of knowledge since the ancient era, managerial economics is an emerging branch of economics which integrates business theories with practical business applications. In early days, when business was less competitive, the application of economics to business was not considered to be important. But with the considerable amount of changes in the business landscape and the cutthroat competition that dominates every aspect of business, makes it important for business leaders in today's world to understand economic theories and apply it prudently to the business to ensure steady growth and profits and to achieve the desired business goals. Managerial economics help business leaders take managerial decisions in an informed manner by basing their decisions on the principles of economics. Almost any business decision can be taken with the help of managerial economics. While some businesses may utilize the study of managerial economics and have the leaders directly apply the knowledge to their business decisions, other businesses may employ managerial economists who assists the business in taking decisions. Introduction. Managerial economics creates a bridge between the theories of economics and practical application of these theories in the actual business environment. Business leaders are studying managerial economics because this branch of economics helps in providing them with the ability of ensuring the smooth functioning of the business by effectively applying economic theories to the business. Managerial economics started gaining traction after Joel Dean published the book Managerial Economics in 1951. The ideology behind managerial economics is that economics gives the tools, while managerial economics gives the insight of utilizing these tools in any business. It is meant to aid business leaders in handling the problems of management in an effective way. Economics is considered to be one of the most advanced social sciences because it includes clearly defined theories and theoretical structures. Managerial theory in economics refers to the theories and application of theories which directly impact businesses and the decision-making processes in management. Managerial economics is the science of applying economic concepts and theories to decisions taken by the managers in a firm. It is considered to be primarily normative in nature. This means that it describes what should be the things as opposed to positive economics, which is mainly concerned with what is regardless of the moral and ethical aspects associated to the problem. Since managerial economics is meant to help business leaders take effective business decisions, it must be able to tell the leaders what should be done. For example, what should be the price of a product or what should be the wages paid by the firm to employees of different levels. While positive sciences are pure in nature and do not take any morals or ethics into consideration, normative sciences take many factors, including moral and ethical questions, into consideration so that leaders can take decisions more effectively. This is why normative economics is also known as perspective economics. It helps business understand not just what happens, but what should happen to achieve certain objectives. It is based on factual studies and is propelled by logical reasoning. Managerial economics involves a wide range of studies and it aims at providing solutions to almost all business-related problems in a firm. Popular economists define managerial economics in the following ways. E. F. Brigham and J. L. Papper. The application of economic theory and methodology to business administration practice. Christopher Savage and John R. Small. Managerial economics is concerned with business efficiency. Milton H. Spencer and Lonnie Siegelman. The integration of economic theory with business practice for the purpose of facilitating decision-making and forward-planning management. Menard and Merriam. Managerial economics consists of the use of economic modes of thought to analyze business situations. A fundamental academic subject which seeks to understand and analyze the problems of business decision-making. Managerial economics is the study of the allocation of resources available to a firm of other unit of management among the activities of that unit. Floyd E. Gillis. Managerial economics deals almost exclusively with those business situations that can be quantified and dealt with in a model or at least approximated quantitatively. McGutton and Moyer. Managerial economics is the application of economic theory and methodology to decision-making problems faced by both public and private institutions. Lesson 1. Characteristics of managerial economics. First, managerial economics is a science. Science is a systematic set of rules and principles which are based on methodical observations and help in achieving certain goals. In this regard, managerial economics is also a science of decision-making where a firm or a manager deals with factual data and existing resources, applying the knowledge of managerial economics to come up with effective decisions that can help the firm achieve specific business goals. Just like science bases all conclusions on the results obtained from constant experimentation, managerial economics is based on the continuous testing and on the factual data obtained from the firms. Businesses have a human variable that still leaves a possibility of unpredictability in the decisions taken by the managers. However, with constant testing, the gap of unpredictability is minimized as much as possible to ensure that managers can take the best decision based on past data and observations. Second, managerial economics requires art. It is important that business leaders and managers have the art of utilizing theoretical knowledge by applying it effectively to the existing business problems. The art of using one's knowledge and applying it is important for any managerial economist or leader to effectively use managerial economics. By putting the theories into practice, leaders are eventually able to reap the benefits of managerial economics. It may sound extremely simple, but it may not always be easy for managers to apply their learning effectively. When they begin to do so, then managerial economics comes into effect. Third, managerial economics is pragmatic in nature. Microeconomics is based on certain analysis and exceptions which may often be very different from reality or the practical business landscape. On the other hand, managerial economics is based on very practical and realistic scenarios where day-to-day business problems are solved on a real-time basis by managers with the help of economic theories and concepts. Managerial issues hardly take into account far-off economic theories that consider unrealistic situations. Managerial economics is all about connecting theories to actual problems faced by firms so that effective solutions can be obtained by the managers. Fourth, managerial economics features certain aspects of microeconomics. Managers utilize managerial economics to find solutions of business problems faced by the firm on a real-time basis. They study and manage the internal environment of the business, and they come up with business solutions that can help in the smooth functioning and long-term profits of the firm. This part of managerial economics shows components of microeconomics, since managers are dealing with the issues faced by the individual business organization, which may include the business goals and objectives set by the firm, the demand and supply of the product or services of the firm, the price of the products, the availability of labor and the supply of raw materials. All of these problems are dealt with on a micro level as concerns of the individual firm. The managers try to find solutions for the individual firm and take into account human behavior and reactions for the individual firm. Fifth, managerial economics has some characteristics of macroeconomics. In addition to having components of microeconomics, managerial economics also reflects certain characteristics of macroeconomics, since managers can hardly have a firm work in complete isolation. The external environment plays a role in determining many solutions for any organization. These external factors can vary according to the industry, but some of the most common ones include government policies, the current income level of the economy in which the firm operates, the availability of labor and employment levels of the economy, the stage of the business cycle in which the organization currently is, the overall general expenditure of the firm, the current market conditions, the different behaviors of the consumers in the market where the firm operates. All these external factors are studied as a part of macroeconomics. This is why managerial economics has some components of macroeconomics as well. Sixth, managerial economics is fundamentally normative. This branch of economics deals not just with the goals of the organization and the different problems that are being faced by a firm, but it also provides the tools through which a solution can be obtained. It is an applied discipline that helps companies understand a situation and take effective steps to solve the problem. In doing so, it helps the managers apply their theories and concepts of economics to the problem to get a workable solution which is in accordance with the business objectives of the firm. This application of economic principles by managers characterizes managerial economics as normative. Seventh, managerial economics assists firms in optimum resource allocation. One of the biggest problems for managers in an organization is to ensure that resources are optimally allocated. While some resources may be scarce, others may be available abundantly. It depends on the manager how these resources are effectively allocated to make sure that the organization can earn long-term profits. Since every resource could have a number of users, the knowledge and decision-making abilities of the manager helps in deciding how the resources are allocated. To make sure that the resources are effectively allocated, the manager must use his business acumen and the knowledge of managerial economics. Eighth, managerial economics is dynamic in nature. Organizations cater to the needs of the consumers. Managers have to continually understand and analyze the changing needs and demands of the consumers to make sure that the firm is able to meet the requirements of the end user. Human behavior is dynamic in nature. This is why managerial economics is also dynamic. The solutions provided by managerial economics change according to the changing human behavior. In order to ensure that the business continues to earn profits, managers have to study the changing needs of the consumers and cope with the dynamism and vitality of human behavior. This eventually brings changes in the solutions provided through managerial economics over a period of time. Ninth, managerial economics supports corrective decision-making. The primary objective of managerial economics is to provide leaders with the ability of corrective decision-making. It helps managers chart the steps taken by a firm to achieve specific business goals and to ensure that the firm is led on the path of long-term profits. It takes into consideration the existing results and behaviors and helps the firm formulate future policies which can help the firm operate effectively even in a diverse business environment. These are the main characteristics which identify managerial economics. It ensures that managers have the most effective set of tools to handle various business situations and to ensure prudent decision-making among the leaders of a firm. Managerial economics deals with goal determination, future planning, appropriate allocation of resources, judicious policy-making, effective achievement of goals, and using the concepts of economics on a daily basis to resolve problems faced by a firm every day. It prescribes the means through which business problems can be solved by managers and helps them attain better profits to the firm. Lesson 2. Principles of Managerial Economics. Economics is based on logical reasoning, and it provides a number of principles that can be used by managers to resolve business problems faced by an organization. These principles help in developing business intellect and robust decision-making abilities in the leaders. Managerial economics utilizes the following principles. First, marginal and incremental principle. According to this principle, if the firm's objective is to maximize profits, then the application of this principle should help in the increase in profits for the firm. This increase in profit can result in any of the following two ways. 1. When the total revenue of the firm increases more than the total cost of the firm. 2. When the total revenue of the firm decreases less than the total cost of the firm. Marginal analysis takes into consideration the impact of the unit change of one variable over the other. This means that it deals with changes on a smaller scale, where its analysis per unit changes. Incremental analysis, on the other hand, judges the overall impact of one variable over the other as a result of a managerial decision. The marginal and incremental principle can help managers understand the cost and revenue from a business decision and whether that business decision will be a profitable one or not. In managerial economics, this principle helps the leaders identify if they should proceed with a business decision or not to make sure that the firm continues to earn profits. For example, some managers may only consider taking up orders which lead to a profit. So if the order does not cover the entire cost of the job, then they may reject the job. However, by utilizing the concepts of the marginal and incremental principles, managers will be able to identify if resources are available which are not being used to their full capacity and can hence be utilized for the job in order to reduce the overall cost and gain a profit. If a new order is meant to bring additional revenue of 5,000 to the firm and the costs incurred for the order are as follows: labor 2,000, materials 3,000, overhead charges 1,500, selling and administrative expenses 500, total cost 7,000. Since this will mean that the order will create a loss of 2,000, businessmen may not want to take up an order like this. However, if there are resources available with the firm which are currently not being used to its full capacity, then the businessman can use these resources and incur lower costs. So the order may add only 500 to the overhead costs and only 500 to labor because some labors are idle and are available on the payroll, then the overall costs will be labor 500, materials 3,000, overhead charges 500. Selling and administrative expenses 500, total cost 4,500. This brings a profit of 500, which means that the order can be taken up by the businessman since it will lead to a profit on the basis of incremental reasoning. Managers may sometimes have to accept orders on the basis of incremental reasoning. They shouldn't have to do this all the time, but when there is adequate availability of resources which are otherwise idle, then an order that covers incremental costs can be profitable and aid in the growth of the firm. Second, equi-marginal principle. The equi-marginal principle is a common concept that is used by economists to help businesses understand and evaluate the allocation of resources. According to this principle, a resource should be allocated in a manner in which the value added by the last unit is the same in all cases. The business will not be able to reach optimum allocation if the value of the marginal product is higher in one activity than the other. This is why a firm will find it profitable to move the resources from low marginal value activity to high marginal value activity, so that the business can increase the overall value of all the products taken together. MRP1 to MC1 equals MRP2 to MC2 equals MRP3 to MC3. MRP stands for Marginal Revenue Product and MC stands for Marginal Cost. Similarly, consumers will spend money on various goods in a manner in which the marginal utility of each product will be proportional to the price they pay for it. MU1 to P1 equals MU2 to P2 equals MU3 to P3. MU stands for marginal utility and P stands for price. Third, opportunity cost principle. The concept of opportunity cost stems from a very basic ideology that we end up applying in our day-to-day lives when we make decisions which involve a choice between two courses of action. There are a number of ways in which resources can be used. Since resources are scarce, managers have to choose how it is used so that it is profitable for the business. When the resource is used for the production of a certain commodity, it results in foregoing the production of another commodity that uses the same resource. With limited resources, a choice is peremptory since we cannot get everything that we want. In managerial economics, the opportunity cost principle is considered important because it helps the leaders allocate resources appropriately. Additionally, this principle is important in identifying the relative price of goods and the remuneration to a factor production. Opportunity cost cannot be calculated in the books of accounts of a company. It is a concept that is used by the managers to guide their decisions regarding the choices they have to make, which may result in the growth and profitability of the company. Fourth, time perspective principle. Marshall introduced time as an important element in economics. According to the time perspective principle, a person should consider both the short-term and long-term impacts of a decision. It is important for every business to evaluate the revenue and costs of the business in the short run and long run whenever a decision is taken. Firms may not be able to make enormous changes in their output in the short run. They can only change the variable factors, but they may not be able to change the size of the business. But in the long run, business can bring a major change, like changing the size of the business. While some decisions may have to be taken with short-term benefits in mind, managers must also be aware of the long-term repercussions of the decisions that may or may not be profitable for the business. Fifth, discounting principle. To a certain extent, the discounting principle takes into account the time perspective. The value of a currency changes continually, and the value of a currency today will be very different from the value of the same currency 5 years from now. The future holds uncertainty for every business. Managerial decisions involve a certain level of risk with regard to the future, since it is difficult to predict the future of any firm. If you have 10 units of a currency with you today, it may end up gaining interest in 5 years and may become 15 units of the same currency 5 years later. So if you were to be offered 10 units of a currency today or 10 units of the same currency 5 years later, you would obviously choose to take it today. But if you were offered 10 units of a currency today or 15 units of a currency 5 years later, then there isn't much difference in what you are being offered, because the present worth of those 15 units is 10 units. This is why managers must find out the net present worth of an investment to identify if the returns from the investment over a long period of time will be profitable or not. Managers will find this principle to be most useful during capital budgeting and investment planning. The present value of an investment is found out by using the following formula. V equals A to 1 plus I. A stands for the amount invested, I stands for the rate of interest. So the present value of an investment discounted at the end of n number of years is V equals A to 1 plus I, n, where n stands for the number of years. Sixth, risk and uncertainty. Risks are inevitable in a business. Managers often face situations where they have to make decisions knowing that there is a certain level of unpredictability in the future. These uncertainties can exist in the form of changes in industry standards, price fluctuations, labor issues, strategies of the competitors, and the like. Economics, in theory, assumes that businesses are aware of their business environment and requirements. Uncertainty has no room in theory, and it does not have any effect on the decisions taken by the business. However, in reality, uncertainties exist all the time. These uncertainties can make a huge difference in the long and short-term profitability of the firm. Managerial economics takes uncertainty into account by using subjective probability. This helps the managers reduce risks to a certain extent and make room for changes in the environment and to the factors of production to a certain level. Lesson 3. Scope of Managerial Economics. Common theories and concepts of economics that helps managers take practical decisions every day for the business are a part of the scope of managerial economics. It has a narrow scope since it deals with problems at the managerial level only. However, it still involves a number of decision-making situations that the managers may face. With the help of managerial economics, leaders should be able to take effective decisions with regards to the customers, the suppliers, the competitors, and other decisions within the organization. Theory of demand. The theory of demand is among one of the fundamental theories of economics. It answers a number of questions that can help managers take business decisions. It helps the managers understand the reason why there is a demand for the product. The theory of demand helps them figure the amount of a product or service bought by the consumers. Then there are the factors which influence demand in a market or an industry and the behavior of customers to various changes in the pricing of a product. When managers have insight of the demand theory, then it is easier for them to take decisions related to the demand of products and how to allocate resources appropriately in order to meet the demands of the consumers. Leaders in a firm are not just responsible for assessing the current demands of the consumers, instead they must be able to forecast future demands and help the firm strengthen their market position. By ensuring that they are able to aptly meet the demands of the consumers, firms will also be able to improve consumer loyalty. And improve overall profits. Managerial economics includes the study of the demand theory, which includes demand forecasting, demand determinants, and demand distinctions. Theory of production. The theory of production guides managers to determine the size of the firm and the amount of production possible by the firm. It brings light to how the average and marginal costs can change by bringing changes into the production. The theory is also helpful in understanding the different conditions in which costs increase or decrease. The different factors of production are known as inputs in economics. These inputs can be combined in different ways to make sure that the firm is able to get the maximum output. Managers must be able to identify the best methods in which the firm is able to enjoy better output, and when the cost of these inputs increases, it is the decisions of the managers that can help the firm identify a way through which the inputs are combined most cost-effectively. In the theory of production, managers learn production analysis, combination of factor inputs for least cost and maximum yield, the production function, and factor productiveness. It helps the managers decide the size of the total output with respect to the size of the firm, and it also assists in deciding the amount of capital and the combination of factors including the labor to be employed by the firm in order to be profitable. Theory of exchange or price theory. Every firm depends heavily upon pricing. It is important for the firm to ensure that the pricing is appropriate to cover all the costs and to ensure the profitability of the firm. Similarly, it is also important that the firm takes pricing decisions which are lucrative enough for the consumers too. In this way, the firm will be able to ensure adequate profits and also fuel loyalty in the consumers. The pricing theory helps the manager in understanding the current market structure and the nature of competition which currently exists in the market. Knowing the costs involved in production and identifying the right production process through the production theory also helps in pricing the commodities. The price system acts as a guide for the managers to take a valid price decision for the firm, ensuring profitability and improving the sales of the commodities. Studying the price theory includes determining the prices in various market conditions, the different types of pricing methods, pricing policies which help managers price the commodities correctly, differential pricing, and price forecasting. Theory of profit. Most businesses operate to achieve the objective of making profits. There are a number of uncertainties which exist in a business undertaking, which makes it difficult for the firm to ensure that they gain satisfactory profits. Profit planning and profit forecasts are extremely complex. They require that the managers identify the most cost-efficient methods for production in order to predict viable profits for the firm. This theory is used as guidance by the managers to help in the management as well as the measurement of profits. It requires the leaders to make allowances for risks and uncertainties, and at the same time helps in calculating the pure returns for the firm. Managerial economics identifies the cause and effect relationship by carefully studying factual data and by logical reasoning. Theory of capital and investment. Capital forms the foundation of any business. It is an important and expensive factor which is not always available easily for the business. This is why it is peremptory that firms allocate this resource efficiently. Some of the biggest decisions that a manager may have to take related to capital are: choosing an investment project that can best achieve the firm's goal of profitability, ensuring that capital is allocated in the most efficient way by the business, making sure that the business operates in a manner that undercapitalization or overcapitalization is minimized as much as possible. Managerial economics also uses this theory to access the efficiency of the capital so that leaders have knowledge of how efficiently the capital is being utilized by the firm. Decisions related to capital and investment can vastly impact the functioning of the firm. Managers must have knowledge about the capital theory to gain insight into the utilization of capital and making sure that the investment made by the firm is profitable. This theory includes studying investment decision-making, choice of projects, and capital budgeting. Environmental issues. Since managerial economics includes certain components of macroeconomics as well, environmental issues are a part of many managerial decisions. These environmental issues consist of the political and social environment in which the business operates. The firm has to keep in mind the economic system of the country where it is operating. It must ensure that it is conforming to the industrial policies of the country and also following the taxation policies prevalent in the economy. Additionally, the firm's managerial decisions are also affected by the stage of business cycle it is in. The social structure of the economy, which includes the value system of the society and the class character of different social groups, also holds importance when it comes to taking managerial decisions. These environmental factors cannot be controlled by the firm. This is why the managers of a business have to formulate plans and policies which can ensure that the firm is able to conform to the social and political environment and operate effectively. These are the different theories that a manager should have knowledge about. These theories help them take practical decisions related to the business most effectively. Since managerial economics is all about applying economic theories and concepts to real-life business situations, these theories are widely used in their everyday business. Lesson 4. Methods and techniques used in managerial economics. These are the 6 methods used in managerial economics to help managers solve business problems and achieve the goals of the enterprise. First, scientific method. This method requires a systematic process of inquiry, and it bases all its knowledge and ideologies on valid conclusions. Scientific methods in managerial economics are usually applied to those areas of managing a firm where the leaders require accurate and logical thinking. While experimentations are usually very limited for managers, many managerial economists find this to be a helpful method. Second, statistical method. Statistics are helpful in comparing different types of data and identifying procedures which are most fruitful for the firm. This method utilizes quantitative data to help the managers take decisions by comparing 2 different phenomena. It is useful for managers because it assists in finding regularities or a pattern in the data, which can help managers take business decisions or forecast certain goals based on the data and the pattern. Third, method of intellectual experiment. This method uses models to explain situations and guide the managers towards a solution. Models can exist in different forms. They can be diagrammatic, verbal, or mathematical. It is ideally classified as iconic, analog, or symbolic. Managers use managerial economics to solve real problems faced by the business. This is why managerial economics has a more concrete base than theoretical economics. Models are considered to be an approximate representation of the reality. With managerial economics being a more practical and realistic branch of economics, model building fits in perfectly. Fourth, method of simulation. With digitization on the rise, simulations have garnered a lot of attention. This method is an extension of intellectual experiment since it takes model building to the digital level. With the help of simulations, managers can find out the impact of the decisions that they will be taking. These impacts can be seen in the short term and in the long term by means of the computer program. Fifth, historical method. The past serves as a guide for present actions. This is the foundation of the historical method. Managers can use the historical method by identifying past trends and taking actions which can help them forecast the future with the help of these trends. Knowing what has happened in the past helps us face economic problems in a more effective manner. Managers should be able to use past data and information to connect events and the environment and identify the best solutions which worked or could have worked in those scenarios. Sixth, descriptive method. This method is used for gaining knowledge. By using this method, a managerial economist can describe the organization and its functioning along with the policies and standards that it conforms to. This information helps in creating data which can be used for gaining knowledge regarding certain economic problems and also to draw conclusions about various situations and results. The descriptive method helps in describing a particular phenomenon which is currently under investigation. Lesson 5. Importance of Managerial Economics. Most firms operate with the objective of maximizing profits. This requires the managers to take decisions which will help in the growth of the enterprise and ensure that the firm is using the available resources in the most effective way. These decisions are vastly dependent on the manager's knowledge of the firm, the environment, and the economic concepts and theories which help in taking the right decisions. Managerial economics is able to establish a relationship between the different factors of production in a firm and helps managers take the right decisions regarding these factors. It is one of the branches of economics which takes the economic theories and concepts and uses it in real-world business problems. It is an insightful way of taking informed business decisions. Through managerial economics, business leaders become more aware of the quantitative data available and ensure that they have adequate information about the factors of production so that they can take the right business decisions. These factors can be external or internal. While the internal factors can be controlled by the firm, the business may not have control over the external factors that can also affect production, sales, and pricing of the commodities. Managerial economics is also considered to be the foundation on which most business policies are laid. Business policies are usually created after the careful study and findings of managerial economics. It helps the business reduce business risks and uncertainties and ensures that the business can be run more effectively and in a way that maximizes the profits and achieves the goals of the business. The decision-making process in any firm is one of the most important steps to success. Managerial economics plays a pivotal role in the decision-making process of the firm, helping managers solve problems related to the business in a better way. Lesson 6. Role of a managerial economist. A managerial economist helps the leaders in the firm in solving actual business problems with the help of his insight of the economy and the theories of economics that can be leveraged to understand these problems and come to an appropriate solution. A managerial economist has to be vigilant of the dynamism of the economy and ensure that he constantly makes use of the changing business environment to the advantage of the firm. He is able to perform this task by studying the economic patterns, going through past data and looking for regularities which can assist the management in solving current problems and forecasting production and sales in a manner that will help the firm increase its profits. While managerial economists have to be aware of the external factors affecting a business, they also have to carefully understand the internal factors of the business which can affect the profitability of the firm. For this reason, managerial economists have to go through details of business factors and assist the managers in taking business decisions which will be able to maximize the use of these factors. He has to use different methods and techniques of managerial economics so that he can conduct detailed research on the industrial market. He must have data and information regarding different economic aspects of the firm, like tax rates, prices being offered by the competitors, and overall standing of the business in the economy. Managerial economists may often have to deal with pressures related to the business since it is not an easy task to convert massive amounts of data into intelligible information that can help managers take the right business decisions. Conclusion. Managerial economics has gained traction in the recent years because firms have started understanding the importance of taking fair business decisions that can propel the firm towards the path of success. Managers are often faced with business problems where they require knowledge of managerial economics to help them take the right decisions and solve these problems in an effective way. Business decisions usually have an impact that lasts for a long time for the firm. Every decision may lead to profit or loss in the long run. While a business can hardly be risk-proof, managers can use managerial economics to identify patterns and regularities which help them notice the ways in which the business can reduce uncertainties and be more prepared for the future. Insight of managerial economics also helps the leaders of the firm allocate the resources in a most profitable way. It enlarges the area of certainty and provides realistic solutions for the problems faced by the firm. Most of the policies and programs of the firm are also formulated with the help of managerial economics. The goals of the company can be achieved in a shorter period of time when economic concepts and theories are successfully applied to the daily operations of the firm. Being practical in nature, managerial economics helps take realistic decisions.